All right, now is a great time to get into Cole's Pro Picks, his top conviction ideas. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right, Cole, your first pick is Strathcona. You talked a lot about the Watrous boys and how you like to invest alongside them. You call them the best capital allocators in the energy space in Canada. They're here in this one. The stock is bouncing off about a one-year low. How do you think about this stock and the upside from here?
Yeah, it's so. Let me give a little back history too. I was up at the Calgary Stampede. This would be 2 years ago. And I remember sitting, I can be naive occasionally, not often, but occasionally. And we're sitting at a sell side event and Adam comes in and he's talking about how constructive he is on the commodity of oil. And he's, talking about what they've seen to build up what was then the Watrous Energy Fund, the various, LP funds that they had. And I turned to my colleague at the time and I said, gosh, that guy is he's just spot on. I said, if we ever could get a chance to invest alongside of him in public markets, I'd love to do it. Well, I was being naive because obviously it wasn't too much later that the Pipestone merger was going to go on that fall. So I say that because, they did the deal. The stock was like in the high 20s, low 30s, upon consummation, quickly fell to the low 20s, has ran up as high as I want to say 35, and it's kind of came back to the mid 20s again. Okay. So what we think is predominantly bothering this stock is nothing other than it's a limited float stock. So for example, there was about 9% that was publicly traded. That was the original Pipestone equity. The rest was owned by the Watrous Energy Fund LP holders, but really controlled by the GP, AKA Adam Watrous as the chairman. Okay. And so recently they distributed 11% of their shares to some of the earlier fund investors for Watrous Energy Fund LP holders. And you've seen that with roughly a little over a doubling of the disbursement of shares, so about 20% are now float, quote unquote, the volume on the security is about doubled. Okay. Now, I point that out because this is a security that if it had 80% or 70% of the stock publicly floating right now, I think you'd see people responding to it differently because frankly, it's one of the largest producers in Canada, but yet it has one of the most limited floats out there in Canada because of these holders. Add on to the fact that we talked about earlier that you have Prem Watsa and some of these people who are collecting those shares. When Prem collects his shares out of the original Watrous Energy Fund, is he going to go out and be like, great, I got my shares. Now I'm going to go sell them? No. So you have these very long-term incented shareholders that are greatly squeezing the liquidity. That's what we see more often than not as a primary reason to keep investors away from the security. When you think about the balance sheet structure, this is an investment grade security. That's been very important to the Watrous family, is to keep this as an investment grade security. Much of that happened as they came out of being public. They took off some of their hedges at the time so that the banks would recognize that they're paying off debt and they want to keep a very high quality balance sheet in that. And we just like the return profile of this business. I think that the discount is showing up via the liquidity today. And so as we look at these prices, we don't think these prices are very connected to the assets they own. These are very long-lived assets. I think that's a feature that we are very much looking for in Canada, as in common with other names we own. But the other, if I was going to give one knock on the security, because of their ownership and the limited liquidity, there won't be buybacks. Because again, how do you squeeze this? But here's what I look at Strathcona for. Strathcona is a vehicle for acquisition, okay? In other words, think of everything I just said about Bouchard at Alimentation Couche-Tard. I think the Watrous family will go out on the acquisition spree in all share deals, but with one caveat. When their stock represents a value, that means they should go do stock deals. And we are not there, in my opinion, and in our opinion. We're not there for their stock, so they won't do that now. But at a higher price on their stock, you will see them go do all share deals. what they can buy right now is at a bigger discount relative to, say, book or the value of the assets, they will go do those, but only if it's discounted relative to theirs. So you could see them picking off some private deals. In the public markets, they might not have enough premium to go do that right now. But I think you'll see their deal activity pick up over the next 2 years because, again, a few weeks ago, some people looked over the edge, even as operators, and said, I'm 60. I just don't know if I want to do this anymore. It's been a good run. Do I really want to have to go through a pounding every 2 to 3 years? And that's just been the nature of the beast. I don't know. So that's one of our largest holdings. I think it sits on our ex-US portfolio, sits something over almost 7%. But again, even we are somewhat limited on the illiquidity of the stock and the liquidity that we see right now, where is it easy for us to go out and add, say, 50 basis points or 1% to our portfolios in that? No, it is not easy. And so I think that's the only thing that holds us back at times from, having a bigger position in the security.
Okay, so let's talk about something that is a little bit more liquid, which is your second pick. That's MEG Energy. How do you think about this one? This one bouncing off about a 2-year low.
Yeah.
What's the upside?
Yeah. So, if someone said, what do I think's really going to get unlocked at MEG? First off, MEG's a single asset basin. So it's like back to my focus idea for the bigger players. It's like, I'm pretty focused to start out with. I have a single asset. That's what Darlene's dealing with, the CEO of MEG. So it's tough to not be focused on that. They have a smaller dividend they've put in place the last few years. Obviously, like I said, I'm not a fan of that. That being said, it's not massive. I think their primary conduit for capital returns will be buybacks. And at these prices, I mean, it's a dream to buy back at these prices. So let me say this. What do we think we're really going to take out in value over the following, 2 years, 3 years, 5 years, is the existing NOLs that MEG has, net operating losses, just to not skip over the nomenclature, is what still sits on the balance sheet of MEG. These are what we'd call deferred tax assets. And how you recognize these deferred tax assets is you create profitable income off your oil assets, but you don't pay any cash taxes. And so there is an argument to make, and this has not been a unique argument. I'm not the first one to make it. I'm just too damn stubborn, and therefore I'm going to recognize this, is that the math works like this. As we look forward 5 years, MEG will recognize those, whether we're at low prices or at high prices. At higher prices, they recognize those NOLs quicker. And if a buyer happened to come in to acquire their stock, in an all-share transaction, what the buyer could do is, if they have similar asset basins in situ, as they call it, they could recognize those NOLs quicker, which means someone could fund the deal premium out of the NOLs over the following 2 to 3 years. Okay,
so in plain terms, this is a potential takeout candidate, very likely takeout candidate?
Well, I just think it's likely because the math makes sense. Do I have some edge in the M&A world and I know how to pick a bunch of takeouts? Not a chance. I mean, that's just not what we do. I just say it because I can, as a financier, I can pen the math out pretty easily. But again, I'm not sitting in a boardroom. I'm not the executive of a major that could do this, but I just know the math works fairly well because MEG is producing very attractive returns on invested capital in a way that most other people aren't. Okay, they're producing mid-teens return on invested capital, and it doesn't trade for much more than book value ultimately. So again, you come in and pay a premium relative to book with attractive returns, all stock, so that way the shareholders of MEG are sharing in your risk. And I think that pens out pretty well for a myriad of companies. But again, at this juncture, the question is, who thinks they can go out and acquire attractive assets and be focused on being an E&P? That might not be their focus. They might say, you know what, we think M&A is aggressive. I think there's a lot of low T, or to put it in normal term, low testosterone players in the industry who, because they can't drill, they're not very confident. And I think they're not thinking about this like a financier or an investor would. That MEG is a perfect M&A pitch. It's a banker's dream. And I tend to look at things more like that because I'm trying to get really attractive returns relative to the capital needed to run the business. And that's what MEG fits really well into. Now, do we have to have that? No. We could be Rip Van Winkle, run the business off for 10 years, and we'll recognize all those NOLs. But an acquirer could capture that to take out the assets. And what they could turn around and do is use the excess capital that they're getting off of MEG to go out and buy more stock back. And if the MEG shareholders don't like that, buy them back.
Let's get into your third pick, which is Cenovus, bouncing off of a 3-year low. Quarterly results, I think, like kind of at the end of February, were a miss, and the stock got taken down. It's bounced a little bit since then. You sounded like you were getting a little cautious on Cenovus. Talk to me about, why you still have conviction in the name and where you think it can go from here.
Yeah, the asset basin, long life asset basins are what we're most attracted to, and that's what Cenovus has. Okay, so when I was talking about earlier, their focus, we think that their refinery assets are being priced at zero and plausibly have negative value based on, to your point, how the stock's traded. Okay, so let's just say that theory is right. If that theory is right, recognizing any value in those refinery assets would be more value than we're getting today as shareholders. So recognizing the value could be selling the assets. Recognizing the value could be spinning those off tax-free and letting Mr. Market, as Ben Graham once said, value that in an open, fair market way, maybe in the United States. I think people are looking at and really frustrated with the refinery assets. Now, is it smart to be worried about the refinery assets? No, it's a small part of the business. If I remember correctly, off the top of my head, Cenovus, they only refine about 20% of their existing production. So the idea that that's the mainstay of the business, it's not. But that's what came in via the Husky deal predominantly was the refinery assets. They've since acquired to fully control some of their assets that they shared with, say, BP, for example. And so they've been buying the other joint venture stakes in their refinery assets. But they're now in a position where if you want to spin those or sell those, you have 100% control. You're not sitting there with your JV partner debating whether you want to sell those assets. I think it's in a very marketable position if they so choose to do that. But again, we want their existing production. We think their assets are great. The valuation of the stock is trading, call it 1.5 times book or less. And again, we're getting the return profile that we want. They're not producing just over 10% returns on invested capital. We're in the mid-teens world. And if I just run those businesses off, it plays in that same paradigm. So if I was, I didn't mention this enough earlier, but reserve life, how long you can produce these assets. That's what the Americans on the other side of the border are going to have trouble with. They're going to have trouble recurring their flowing barrels currently because of the drop-off in Permian assets are very high drop-off, 2 to 3 years of great cash flows. And then you go to the floor after that. These tar sands businesses produce long reserve life, and therefore it's your more maintenance capital. And like I commented with Meg a little bit, but Cenovus too, I'm really glad some Canadian investor or foreign investor many moons ago capitalized these tar sands assets and built them and paid prices to do that make no sense. But there have been write-downs to go on in these respective businesses and recognize lower value on the asset basin. And that's why we're seeing these historically high returns on invested capital, even at lower parts of the cycle, is because the assets are looked with very much of a disdain. And even though Canadians report an IFRS, we don't think there's willingness to adjust the books up to probably where the book value of these assets are, which is why the returns are looking attractive relative to the past.
Cole, thank you so much for your time and especially your thorough response to a lot of these individual stocks. I appreciate it.